Yeah, welcome to Nulua. Please acknowledge if you can hear me by dropping a reaction. Demilade Adeyemi, if you can hear me, just drop a reaction. Great. Let's wait for one more person before we kickstart this meeting. Today we'll be talking about something very fundamental. We are already done with the beginners class, so all right, Demilade, I can see your message. All right. I said we're already done with the beginners class, and then this particular part you are moving into, you've you have to pay like extreme attention to everything that I'm going to say and everything that I'm going to show you because that actually determines how profitable you would be in the future if you don't understand this core principle of the market. So we are not even diving right into the chart yet, although I'll be showing you some stuff on charts, but there are some things that you want to understand on charts before you even start trading, some fundamental things about the market. Once you understand that, and then you can put that at the back of your mind, the rest is easy. Okay. All right. We have the third person, John Liberty. Welcome. I will share my screen right now so you guys can actually tag along. Please, I can never can see my screen. All right. If you can see my screen, drop a reaction. You should be seeing infinity screen like right now. Julius, can you see my screen? Good. All right, John, thank you. All right, like I said, today we'll be going about, we'll try to understand some things about the market, the fundamental nature of the market, the way the market operates. Because, hold on, guys, just give me 1 minute. Yeah, can you hear me perfectly now? You guys should be hearing me right about now. Emmanuel, did you? Okay, John, do you want to talk or you are just hearing me? Just drop a reaction or drop it on the chat. Okay, yeah, that is very, very cool. So, what I'm trying to say is this that now that I want to start trading the market, you guys are taking your first trade, and then you you saw something. Something happened when you took that trade, when it triggered. It went into loss for just a minute and then it went to profit. But then there is something I want you guys to understand today. Some fundamental things about the market that once you guys can understand it, sleep with it, that is, this foundation is something that most people do not have. But then I'm starting with the basic foundation. So your foundation will be strong. And when you start trading, it will be very, very easy for you. I'm not going to start with all those shit that most people teach about, all those candlesticks. We'll get there, but there is something I want you to understand. You've already understood risk management. This particular side is another thing I want you to pay attention to, like this. Your rapt attention is what is needed here. Okay. And whatever I say, you can jot it down in your book and review it as we go along. It will make sense later in the future. Okay. So now let's move into the overview of the whole thing that I want to let you understand. In game theory, there is something called a zero sum game. Do you get? A zero sum game is a game that, like, for one person to win, another person has to lose. That's a zero sum game. And then there is positive sum game, that is everybody wins or less people loses. Everybody wins the game. That's a positive sum. When larger percentage of people wins the game, that's a positive sum game. And then a negative sum game is this kind of game that no matter how much you play the game, a lot of people will lose. Even those people who seem to win have already sacrificed a lot of things. Like what's it called? If you guys have seen Squid Game, even though the last guy won 45 billion once, he he has already sacrificed a lot of things. His mental health, he was no longer balanced again. That's a kind of negative sum game. That is, everybody loses. But then the market is not a positive sum game, it's a zero sum game. What do I mean by a zero sum game? It means if I'm losing 1,000, you are gaining 1,000. How do I make that make sense? If you are selling, if you bought a, let's assume you are selling a phone, you imported a phone from China, and then the price of the phone, in Naira is about 280,000 Naira, okay? And then you sell the phone to somebody. You sold it to that person for the price of 300,000 Naira, and the person bought it. Yes, the person got the phone, but you gained 20,000 Naira, right? You initially bought the phone for what? For 280K. And then now you are selling for 300K. You made a profit of 20,000, which means somebody must have given you, like you must have made a profit off of the buyer. That's basically it. It's a zero sum game. The 20,000 that the buyer lost, you gain it. That's how profit are made. Life is literally kind of zero sum. Part of life is zero sum. That's the first thing I want you to understand. So the markets are zero sum. It means for somebody to win, for you to win, somebody else out there has to be losing. That's the reality of the market. If you are losing, somebody else out there is gaining. So that's the reason why I taught you risk management first. That if at all you lose, you are not losing much to another person. Do you understand? If at all you lose, you only lose a little, and if you gain maximum. Like I said, you only risk $10. Was it $10? Okay, yes, $10 to gain $50. Which means for every $10 that you gain, that you risk in the market, you gain $50. Which means after you gain that $50, if you take 5 more trades again and you only win 3, you are still net positive. I think you guys already understood that now. That's the way to play this game. That is, if at all you are to lose, you are not losing too much. And when you gain, you have to gain very, very big. Not a lot of people know this. That's the reason why I'm telling you that. So the first point is this, that the markets are what? Are zero sum. And then liquidity grab happens. I would explain that a little, but then when we get to the chart, it is going to make a lot of sense. Liquidity grab happens because large institutions like bank, hedge fund need to induce weaker player to enter position so as to provide liquidity. What is liquidity? We are going to get to that. But first, this is just the overview. So now, money transfer. When we were doing the beginners class, we were talking about the fact that the market, like the daily market cap of the market, or the total daily turnover of the market, is about $7 trillion. Where is the $7 trillion coming from? Is it that the market created it? No, the market did not create it. Some people put 7 trillion, oh, like a lot of people, even if you deposited 1,000 today, you add to that $7 trillion that is in the market. So a lot of people deposited money into the market that they want to trade for profits. Do you get? That money is not created from thin air. No, you are not making money that is created. No, you are gaining money from someone. Even with Bitcoin, also, if you gain any money in Bitcoin, some people somewhere has already lost that money that you gain. Do you get? So how is Bitcoin worth a thing? The reason why Bitcoin is worth anything is because people put money into it. So everything you are seeing, everything you'll be seeing on charts, the movement, I want you to think of it as money moving. Do you get? This particular sale that happened? I didn't trade this. It was GU that I traded. This one. This particular sale that happened, it was because money moved from GBP to USD. So anytime you see a move in the market, always think of it as what? Always think of it as money is currently moving. The question is, where is money moving into? Is money moving into GBP? If money is moving into GBP, then it will be going up. Or money is moving into USD. If money is moving into USD, then price will be going down because GBP is the base currency and USD is the cost currency. You guys already understand that you're no longer beginners. So let's continue. So market is all for wealth transfer, basically. For you to gain, somebody else has to lose. Before I move to the next slide, did you guys hear everything I said? Do you have any question before I move to the next slide? If you understand everything I've said since morning, drop 777 on the chat. Good. Temirade, I can see you. One more person. Drop 777. If you understand every single thing that I just said. All right, good. Let us continue. This is just the overview. Like, this is what will cement your solid foundation in the market. I can't just go into the market and start teaching you how to look for patterns and stuff. No, you have to understand some basic thing about the market. So when I start showing you, it makes sense. Okay. Now, the fundamental ideas that I want to show you, that I want to tell you, what is a market? Forget the market. Like, this is a market. Like right now, all these charts is a market. But let's talk about the local market, the typical market that we have. Do you get? A market is a place where people trade. A market contains two participants, the buyers and the sellers. That's all. If you are not a buyer in the market, then you are probably selling something or you are playing around. But for any market, for any transaction, there must exist two sides, the buyer side and then the seller side. So a buyer, like the first example that I made, you were selling a phone. In this case, you were a seller selling a phone for 300. You were initially a buyer. You bought the phone from China. Everything that covered the phone was 280K with the shipping fee and everything was 280K. Then you became a seller again just to make profit. It means even in that's the way financial market works. If you buy a currency, for you to actually make that profit, to realize that profit, you have to sell that particular thing that you bought back for higher price. Look at this now. If you bought something, let's say you buy GBP for an example, price has to go up and then you sell at higher price. That's the only thing that can guarantee your profit. Do you get? Let's assume this is not GBP, this is just phone. Do you get what I'm trying to say? You buy at the low, that is at 280K, and then you sold at 300K. And then you made a profit of what? 20,000 naira. Easy peasy. So a market is a place where something is traded. And now let's talk about financial markets. Like I said, financial is a place where currencies are traded. That's something that you're talking about is currency, stocks, crypto, anything financial, anything assets. Okay. So financial market is where assets are traded. And then what do I mean? It is where assets are bought and where assets are sold. Assets like what? Currencies, like we are trading right now. You know, we are currently dealing with the FX part of the financial market. We'll still get into crypto, and then not a lot of stock, just overview of that. All right. But basically, cryptocurrency and forex. All right. So assets like that, that's the financial markets, basically. Now, the key idea I want you to take along here is that for every market, that is for every trade that you take, there has to be a buyer and a seller. Let me put the word willing buyer and willing sellers. Look at this. For every single trade that would happen on this chart, that is this sale that happened, this sale that happens, there must have been a willing what? A willing seller and a willing buyer. Somebody is raising up their hand. Not seeing my screen. Oh, sorry. All right. How about now? Can you see my screen now? Julius. All right. Now, principle one, the first thing I want you to take care, like before I move to the principle, is that in a market, there exists two sides. One side is the buyer side, and then the other side is the seller side. Do you get? That's the first thing I want you to understand. Can you guys see my screen? Are you guys still there? Okay, somebody should just drop something on chat. All right, cool. Now, principle one that I want you to write down in your book that you should never ever forget, that the market exists because people have different opinion about what something is worth. What do I mean by that? The phone that we are talking about, you know, let's assume when you wanted to sell the phone, you didn't just call it 300,000. You called it 350,000. And the person will be like, why would I buy this phone for 350,000? I bought 320, I bought 290,000. You said, no, no, no. Why would you buy it? You bought it for 300K. Why would you be selling it for 290,000? You are literally lying. But there is lying when you are negotiating. But then there is something I'm trying to bring out. You as a seller, you are trying to negotiate a price. Okay. And then the buyer also is trying to negotiate a price. Then you meet at a point called the fair value, a fair point, which was the 300,000 that you eventually sold it for. Do you get? That's the fair price that, okay, it's fair to both of you. If I sell it for 300K, you tell him that I'm not even making any profit because you made 220,000, but you're not going to say that anyway. But then you eventually sold the phone for what? 300,000. Okay. The buyer agrees, and then you have a fair price. So the first thing is those times that you are negotiating. Okay, let me not go deep. Let me not go that deep. I don't want to relate to the market first. I want you guys to understand it first. The reason why the market exists, any market at all, is because people have different opinions about what something is worth. Do you get? People want to make profit, so they just tell you this is what this is what this. They give you their own price, and then you buy it. Different prices every single time. But then if it is too expensive, you guys will negotiate until you meet at the fair value. That fair value is called what? The equilibrium. Okay, that's economics for you, basic economics. Okay, the equilibrium price is where, okay, this is the fair price I can buy this thing. This thing is worth this price. I can buy it, I'm not losing, and then you can buy it, I'm okay with that. So that's the fair price. Understand the fair price. Okay. Now, for example, if you want to buy GBP USD at 1.2935, somebody else has to sell at that same price. That's provided there are only two people in the market. Do you get? Like this now. What was the last trade that we took? We took this trade. Do you get? Let me try to make sense of it. This was the trade we took together. This particular trade. Already there were sellers here. Obviously there were sellers here. Do you get? That was the reason why we had this particular move down. Then when price came back there again in the future, there were still sellers. But then some people were willing to buy from them. But I will explain the real reason why markets went down later in the future. But for any transaction to happen here, there, like what was even the price? The price is 1.260003. For you to buy or sell at this particular place, somebody must be buying from you. That is, you made a profit of, I don't know, most of you, like I saw about 4 screenshots of those people that set the limit and did the tax. Most of you made around $50, roughly $50 each. It means somebody out there lost $50, but you don't know the person. It's just you are looking at your screen and then you are making wiser decisions than the person that lost the money. Because as you are selling right here, some people are buying. Do you get? But the sellers won. I will tell you the reason why the sellers won here later in the future. But first, understand the market that for you to have sold here that day, somebody bought from you. Okay? Do you guys understand that before I move to the next slide? If you understand this, drop 777 again. I just need 2777 and I'll continue. All right, Tim Larry, thank you. One more person, and then I'll continue. Good, Julius. Now, let's move on. You understand what the market is right now? It's a place where something is traded. In financial markets, that's something that we are trading is currency. That is, the asset we are trading in the forex market is our currencies. But we also have different financial markets. We have the crypto market, the stock market, the commodity market, the futures market, the currency market, the forex market. But then we are trading the forex markets right now. So currencies are what we are dealing with. That's the reason I'm showing you GBP So now, the reason why market exists is because the people have different opinions of things. What something is what. That is what that thing is what. People have different opinion of it. Now, let's move to principle 2. What is liquidity and why does it even matter in the markets? Now, let me explain what liquidity is in a way that you guys would understand. Now, you have a phone. Let's assume, okay, you bought, okay, let's assume you ordered another phone. You've already made 300,000, right? Now you ordered fake iPhones. Do you get? You ordered, iPhone is extremely expensive. So you ordered iPhone 16 fake. Do you get? From China made. And then they sold it to you, everything with the shipping fee, everything that cover each of those iPhone is 100,000 naira. So you bought three because now you have 300K, right? So you bought three of it. So when you bought three of it, you've already gotten it. Now you want to sell it for how much? Let's assume you are extremely greedy. You want to sell it for 1 million. You don't want to sell it for lower price because you don't want people to find out that it is fake. But let's assume, do you get? You got the phone now. You have three phones. And then, how do I say it? You want to sell it. You need liquidity. As a seller, like you're a seller now, you have three phones. You need liquidity. What is liquidity? Liquidity is the ability of something to be easily converted to cash. That is, let's say you need 100,000 right now. You can actually change the phone to cash. But if there's no liquidity, it means there's nobody to sell it to. There's nobody buying it from you. Do you get? Like now, that particular phone, you are looking for seller, you are looking for buyers. At first, because it is iPhone, your price is 1 million naira, but nobody is buying it from you because nobody is interested in any iPhone anyway. And then immediately you touch it, you realize it is fake. Do you get? So you as a seller, there's no demand for your product. There's only supply. Do you get? And you want to sell. You have to do something so that people can buy it. You have to drop the price down because there is no buyer for your product. You drop the price down to, like, say, 120K. From 1 million to 120K. You don't want to be greedy again. People already caught you that it's a fake. You are selling fake iPhone. Do you get? So why did you drop the price? You are dropping the price to look for liquidity. That is to increase the demand for that thing. Because if the price is low, people are more. If something is cheap, like economists believe people are more, are more prone to buying that thing. So you drop your price from 1 million to 120,000. Same thing that happened there. Do you get? Even though, like, there were a lot of sellers here, do you get? We were selling with them, but because there were not enough buyer, price has to drop. That is, the price of this currency had to decrease until they found a buyer around here. Do you get? But then I don't want to explain the other side right now. But the reason why price will go down is because it is seeking buy side liquidity. I will explain that later. You as a seller of that phone right now, you are looking for buy side liquidity. That is, you are looking for people who are going to buy your stuff. That's the reason why you are dropping the price until you get to a point where people are interested in it. Do you get? That's what we call the equilibrium price. That is price that people are actually now interested in your stuff. They've already negotiated it down to 120K. Now, let's assume now you sold one for, what's it called? You sold one for 120K. You made 20,000 profit again. Good of you. But now nobody is buying. 2 days, you've not sold any iPhone. So you just found another person, like out of luck, you found another person that said, I have 80K right now. I'm going to buy this phone. Do you want 80K or not? And you need money urgently. You're going to have to drop your price down again to look for more buyers. That is, to make sure that person buys it, you are going to have to drop the price again to what? 80K. You see, the reason why I'm telling you this, I'm making it extremely simple to you, is because once you start looking at the market that way, you start to understand some things. Do you get? But then I want to make it extremely simple, then increase the complication as we go in this training. So the first thing, that if there's something I want to achieve today, what I want to achieve today is the fact that I want you to see market as any other market. Like, I want you to see it not as all these things that people call it Fibonacci, demand and supply, all this strategy that people use. No. Think about it first like a normal market. Then the rest of the strategy that I give you, whatever, would make sense to you. Okay? So let us continue. Now, you need liquidity. Liquidity means how easy it is to buy or sell something. Now, when I said you dropped the price from 1 million to 120K, so it's because there was no buy side liquidity. Now let's flip the script. Let's assume there is somebody who now has original iPhone 16 Pro Max, 1.7 million. Do you get? Now, there's somebody who has it. And then let's now assume there is only one iPhone in the world. Just that one iPhone. You have 1.7 million. I have money. And okay, let me look at some people from this particular meeting. Collins has money. Eze has money. Emmanuel has money. John has money. Julius has money. Everybody has money. Now, remember, there is only one iPhone and there is nobody producing it. I'm interested in that iPhone. I said I'm going to buy that iPhone. There's only one. Okay, let's assume I'm the seller right now. I'm not buying iPhone now. I'm the seller. I'm the only one with the original iPhone. Like, I'm the only one with the real one. So I want to sell it for $1.7 million. That's the starting price. Emmanuel brings in 1.7 million. Immediately, I see Collins saying, Alpha, that your phone where you post last week, I want to buy it. Do you get? So he said, I like it's the price 1.7 million. I saw Collins offering 1.7 million. I saw Emmanuel offering 1.7 million. Everybody is offering 1.7 million. They all have money. But then I can only sell it to one person. That is when demand is higher than supply. That is, there's only one supply, one iPhone in the world that I have. And then a lot of people are willing to buy it. What would happen? I would have to, you guys would have to come to my side, and then I will sit you down. And then you will have to bid for it. That's where bidding starts. But the bidding is going to start from 1.7. Since everybody can afford 1.7, Easy just said, okay, I'll buy it for 2 million. Then some people will drop off the game. They'll be like, I don't have 2 million, I only have 1.7. Then let's say out of nowhere, John Liberty be like, no, I'm buying it for 2 million and 5 naira. Easy said, no, you're not buying it for 2 million, 5 naira. I'm buying it for 3 million. You remember this scene in what was it, Batman, I guess, that he was trying to bid for something. He was like extremely rich. If you guys remember that scene very well, that's the same thing. You know what is happening here? I'm not doing anything. I'm just watching you guys bid, but I'll be the one to be saying, okay, how about 3 million? Easy said, Easy raises his whatever flag he's using. Then, just when I was about to say sold, Emmanuel John said, okay, 10 million naira. Sorry, 10 million naira. Then that was when Easy dropped off that. Why would I buy this one for 10 million naira? Then we'll be like, sold to who? To John. Now, the price went from where? 1.7 million to what? 10 million. How is this even possible? It's because demand is fucking greater than supply. There's only one iPhone with lots of buyers that are offering different prices at it. Remember what I told you in principle one? People have different opinions about what something is worth. People have different opinion about what the iPhone is worth. Now, let's go back to the market. The reason why this whole thing would go up is because demand is higher than supply. That is, there are more buyers than sellers. Now, people will be thinking as, okay, we have 10 different buyers for one thing. See, we can have, okay, let's think about this for an example. I have 10 iPhones for all of you. Do you get? Okay, no, let's do it like this. All of you has the original, you have the iPhone. Do you get? Let's now assume you have the fake one, 100K, so that you guys, so that it can be relatable. How many are we here? We are about 6 or 7. 1, 2, 3, 4, 5, 6, 7. So 7. Everybody has iPhone each. And then I'm the only buyer. I want to buy iPhone. Now, what you'll be thinking right now is supply is greater than demand, right? But then that is wrong. You can't know that yet until I tell you what I want to buy. Yes, I want to buy iPhone until I tell you the quantity I want to buy. Now, there are only 7 iPhones, each of you, different sellers. There are 7 sellers, and then I'm only one buyer. But then I told you I need 100 iPhones because I have 100 children that I want to give iPhone to. But there are only 7 iPhones. In this case, even though I'm the only buyer, the demand is still far greater than the supply. Do you guys understand? So when I say the supply is greater than demand, or buyers are greater than sellers, I'm not talking about the numbers of buyers that is available in the market. I'm talking about quantity. I'm talking about volume. Okay, I'm trying to buy 100 iPhone, but you guys only have one each. Do you get? There are, there are 7 sellers in this case, but you have only one iPhone each. So that means there are only 7 iPhones available. That's the supply that is there, not 7 sellers. There is only 7 iPhone, and then the demand is 100. I'm demanding for 100 iPhone, which means, you get what I'm trying to say. There is, you guys will have to find a way to get 93 more iPhone. The only way that works is if you increase the price of your iPhone. If you increase the price to a point, you'll be able to produce more iPhone. Do you get? That's the reason why price will increase. Do you guess what I'm trying to say? Before I move on to the next slide. So before I go there, for big players like banks or hedge funds to make their trade, that is, for them to actually pull the trigger, that is, for them to actually buy those Bitcoin is going to 100K or 1 million, there has to be sell-side liquidity. For them to buy something, there has to be sell-side liquidity. The reason why I'm talking about the big players, when we were doing the beginners class, we were talking about the people at the top of the game, like HSBC, Hong Kong and Shanghai Banking Corporation, like Chase, all those big ass banks with trillions of dollars, like a lot of money. Do you get? If they want to trade, let's say they want to sell, they need people that is going to buy from them. Do you get? If you buy Bitcoin right now, there is somebody selling it to you. Do you get? If there's nobody selling it to you, trust me, the price of Bitcoin would have gone to like 1 million. But because there's always other side that is providing liquidity, making sure price is not really going as far as, okay, we'll still get there though. We'll still get there. But before we get there, let us go to, what's it called? Let us understand this one, that if the big banks, what I mean by the big bank is, remember in the beginner's class, I was asking you that, who do you think is the best to follow? Is it the people at the top of the food chain or the people are below the food chain? Retail traders are thinking they move the market. No, you said it was the people at the top of the food chain. So when I say big player now, I'm talking about all these big banks, government, people with money, not retail traders that are using 1 lot size or 10 lot size or even 100 lot size. It's nothing. I'm talking people using 1.3 million lot size, 10 million lot size, 24 million lot size, 300K lot size. I'm talking lot size now. I'm not even talking how much they are buying. If I say 300K lots, 1 lot size is what? You are buying what? That's 1 standard lot. You are buying 100,000 worth of that. Now imagine people using 1 million lot size. Think about it. The volume of the thing that they are buying is very much. So there must be the other side liquidity, that is the sell-side liquidity, which, anybody below the food chain is going to supply to them. Do you get? Remember I told you the market is a zero-sum game. All right? If there aren't enough buyers, what would happen? Price will drop sharply. The big bank is trying to sell, but because the supply is great, they are trying to sell. Supply is greater than the buyers. There aren't enough buyers. Price will drop sharply. That was what happened here. Do you get? A lot of people were trying to sell. Do you get what I'm trying to say? The big banks were trying to sell, but the reason why it went down is because although they've already they've already absorbed a lot of buying pressure. A lot of people that want to buy from here. Do you get? A lot of people that is buying these breakouts, they've already absorbed a lot of it, but their selling power is still greater than even the total numbers of buyers here. That's the reason why we see price looking for more buyers. Then we find more buyers here. Price went up a little, then they sold more again. Then this is the last sale that they did. Do you get? Now, when we talk about taking profits, I told you if you sell something, somebody has if you sell something, you have to buy that thing back to make the profit. Do you get? Somebody has to buy it from you. But then I will explain that later. I don't want to confuse you right now. I just want you to understand that the reason why this price is going down is because it is looking for what? It is looking for buyers. So it found buyers here. That's the reason why. That's the reason for this consolidation. Do you get? So when price, I don't want to be explaining strategy right now, but just understand that they paused here, and then also they found pause here, and then price started reversing. They started finding buyers. Then when price got here again, But then I will explain all these things later. But I just want you to see it in form of market that some people are buying, like demand and supply. Do you get? So before I move to the next slide, do you guys understand principle two? What is principle two? That is, you need liquidity to trade. Do you get? And then when I talk about market maker are people who provide liquidity in the market. And then they are the people who, when we get to other period, we are going to talk about it. They are the one who pay your order. That is, I told you that they were trying to sell here. Who are the people that actually match orders? That is, all the order they are trying to do, all the buyers, they are matching those buy order with, they are just doing it. They are the what? They are called the market makers. They are one of the markets, they facilitate market, they provide liquidity. Do you get? But that's their job. They don't manipulate the market. But the people who literally manipulate the market are people bigger than all of us. Do you get? They are the big banks. That is, people that are only there. They have money. They are trading for profit. They are not market makers. Most people convince market maker with people that are moving the market, manipulating the market. That is, market maker don't manipulate the market. The only reason we call the people that we call market maker are people who has the ability to move the market the way they want. That's the confusion that is there. But basically, market maker don't manipulate the market. The only thing they gain from is spread. But there are people that actually really, really, because they have a lot of money, they just want to manipulate the market and move market anywhere they want. You get? It's the same people that will just sell Bitcoin and Bitcoin will go down. They'll buy from the low again so that it will go up, but they will liquidate a lot of people before they start buying. Liquidating a lot of people means a lot of people are out of the market, so they are buying up, they are matching their orders, they are buying up all their closed position. But then that will be explained later, a little later in the future. So let us move on to principle three. Okay, principle three. What is a liquidity grab? Okay, I want you to understand liquidity grab as this. Look at this. You want to sell fake iPhone. You have 3 fake iPhones. Now back to the first example. You have 3 fake iPhones. Do you get? You have 3 fake iPhones. You know it is fake iPhone, but you need buyers. Then you went to what? You went to meet some people that they don't know how to differentiate between original iPhone and fake iPhone. So you brought these 3 boxes to them. You told them that your uncle just sent this to you from United States of America, and then he sent you 4, that you have 3. Do you get? Sorry, he sent you 4 that you are only going to use 1, that you want to sell all these 3. It'll be like, how much? Then you pretend as though you don't know the price. Do you get? They know the price of iPhone. Most people know that it is more than even $1,000, but let's assume it's $1,000. That's 1.7 million. Okay, so you tell them that I don't know it. That I know it is very expensive, but I'll just take, say, 1 million for it. They'll be like, this is a socket. I buy this new phone. This phone inside carton right now. If I buy it right now, I can sell it for 1.7, which is the real price. Do you get? You know what you are doing. You are haunting them basically. Then now, immediately you convince them and manipulate them into buying. Then they bought all the 3 iPhones. They gave you 3 million and then bought all the 3 iPhones. Then you now have 3 million naira sitting in your bank account. You went away. You cannot see them again. Now, before they found out that it is bullshit that you sold to them, you're already on your way to, I don't know where you're going, but then you are nowhere to be found because you already have 3 million anyway. You can go anywhere you want. Do you get what I'm trying to say? That's you doing what? That's the simplest definition of liquidity grab. Do you get? Liquidity grab is something like this. I will tell you why this is liquidity grab. The reason why this is liquidity grab is because there are a lot of traders that believes any break above this high, do you get? Market will keep going up. So they believe if they buy from here, they will make profits. Let's say they believe market is going to get like, to 1.64. So they will buy from here after the break, and then they'll be looking to get what? To make profits when price gets 1.264. But then all they did here was convince people to buy. Okay, market is going up, and sell. Do you get? Which was what happened here. That is liquidity grab. You are convincing the suckers to just jump into the market so that they can actually sell to you. Somebody is saying something. Okay, there must be liquidity. So you have to find a way to produce it. Now, let me now tell you something about the market. All the materials that you think you are reading, probably some of you have traded Forex before. All the materials that you think you are using, who do you think is providing the materials to you? Obviously, the market makers, they will provide you everything you need, give you the hope and dreams that you can make money. Trust me, 90% of retail traders will always lose because there is no way out of it. It's not as if the market is a gold mine where new goals are produced. No, it's a place where it's the West world basically. It's kill or be killed kind of markets. Even crypto markets is killed or be killed. Okay, so all these things that you are learning, Fibonacci, support and resistance, everything, they created everything. They know where they don't know exactly where your stop loss is, but they know exactly what you've read. They know where you are going to put your stop loss. Let's say you are even selling from here. They know you are going to put your stop loss above this high. And then they are going to, what they call the stop loss on liquidity grab. They need liquidity. So they are going to find it anyway. They know exactly the area where most people are going to set their stop loss. It happens every damn time. You see, I'm going to show you, but let me know. I'm not trying to explain something very big, but I just want you to see something. Do you get? Before any big move happens, something always happens. Something like we've already talked about this place, what happened there, and then we've already talked about what really happened there. Do you get? But then I'm going to explain different kind of liquidity later. But firstly, you guys have to understand that somebody must convince somebody to buy so that somebody can sell. But then who do you want to follow? Is it the buyer or the seller? You only want to follow the big banks. They don't tell you when they want to sell, but you need to be able to track their movements. They cannot hide it. Why can't they hide it that much? It's because they have a lot of money to spend. So, if you put $1 billion into this market right now, I will know, because see this kind of move, there's only one person that can do it. This kind of move, there's only one person that can do it. This kind of move up, there's only one person that can do it. It's people with money. They are looking for liquidity. All you have to do is you have to know how to track their footsteps. Once you can learn that thing, you are good to go with the market. Will you be perfect all the time? No, fuck no. You cannot predict all their movement all the time, but larger percentage of the time you'll be able to bank on their moves. Do you get? That's basically what we are trying to learn. But let's leave that alone. You guys understand liquidity, like what stop loss on is now, a liquidity graph is. And then stop loss and pending order creates liquidity pool areas where lots of traders are waiting, where lots of traders are waiting to happen. Example, if a retail trader puts stop loss above a resistance level, there's a pool of buy orders sitting right there. Big players can push markets to that place to trigger that stop loss or trigger those trades so that they can fill their sell at a better price. We'll talk about the rules of sell high, buy low later in the future, but then just understand that for every trade that is going to happen in this market, there must be liquidity sitting. There must be liquidity backing it up. And what is liquidity? Liquidity is nothing more than money. Money is liquidity. So if I say I need liquidity, it means I need money. Basically, that's what I'm saying. All right, you guys understand principle 3. Let's go to principle 4. Why does the market move this way? The market moves because the reason why markets move is because there is a constant tug of war between buyers and sellers. Big players like banks often have the power to manipulate the balance between, those that have money and those that don't have money. And that's because they even have better information and they have more money. They can move the market. I already explained that in principle 3 or 2. And then principle 4 that I want you to learn is the market moves to where the money is. I want you to understand this now. Now, they bought, because money is right here, they liquidated people here. Now, after they liquidated people here, they were able to sell. If they are selling, what else would they be looking for? They'll be looking for buyers, right? Yes or no? Yes. If they're looking for buyers, where do you think you can find more buyers? Okay, before you answer that question, if you want to sell a thing, do you get? How do you think you can find more buyers? Is it by increasing the price of that thing or by decreasing the price of that thing? If you are looking for buyers, somebody should just drop it on chat. You are looking for buyers for something, probably your phone. The best way to get the buyer, is it to increase the price of your phone or to decrease the price of your phone. If you are a seller looking for buyers, just answer whether increase or decrease. Reduce price. Okay. Another person, lower the price. Thank you. Decrease the price. Exactly. Thank you for saying that. That's what is exactly happening here. After they sold here, price is just looking for willing buyers. You know, a place where, you know, some people right here think price is already cheap, that they should buy. You get what I'm trying to say? So the reason why market is going down is because market is looking for buyers, willing buyers that will just buy whatever they are selling. Do you understand? So whenever market is going up, it means market is looking for sellers. You know, there are people that have bought, they are looking for who to sell to. But then I would explain that it will make sense later in the future, like when you are relating it to charts. But those are the basic things, basic principles you need to understand, overstand itself before you can actually make money in the market. If you see, if I really wanted to do like they taught me then that I was losing, trust me, I would have taught you like this that okay, whenever markets just break structure, just look. I don't teach that kind of thing. You need understanding of why you are doing what you are doing before you do it. That's why I'm starting with the basic foundation of things. Do you get? You will never see anybody explain anything like this anyway. All they would start explaining to you is just, you know, patterns and patterns and patterns. What is the psychology behind this pattern? They cannot explain. Okay. And then all this smart money, I think this is where smart money even comes from. This thing that I'm explaining in a very clear way, because everything, how did I understand this? I understand this by understanding how real world market works. Do you get? I've sold something before I became a forex trader, so I understand how things work. I understand how I lower the price because I'm so desperate. See, I saw that when I had issues some times ago, like in 2021, I had issue, I was owing a lot of money. Do you get? I don't want to mention the price of the money that I was owing, but then I had lands. Lands now that like lands then, the lands I wanted to sell then. Because like I had to pay some people, some of my investor money, but I didn't have money at that time. Jigga, I already even lost their money basically. But I had assets. Number one, I had lands. I want to sell some land. Those land, trust me, one plot there would be worth nothing less than 5 million. At that in 2021, nothing less than 5 million. Initially, I bought it for about 3.2 million. Do you get? But in 2021, the price of one plot there was about was about 5 million. I like agree approximately 5 million, okay. But you know, when I had this issue, I needed money like that. Number one, what's the best way for me to get liquidity? I knew is to drop the price. Because if I don't find money soon, there's a lot is going out to me. So I have to drop the price to 2.2 million. I sold the price to people for 2.2 million. This same land that I'm talking about, the price of one plot there now is worth 15 million. But because I was desperately in need of money, I had to liquidate that particular land. I needed to lower the price to find liquidity, to find willing buyers. That's the same thing that price is doing here. Okay? Same thing that price is doing here. I'm trying to sell. I'm trying to look for willing buyers. Trying to look for willing buyers is the reason why price goes down. Do you get? Now, let us continue. Let us continue to principle. Let us continue to principle. How does market find all these things? I would explain to you later. But you have to understand what stop loss is, where people set their stop loss, what stop orders means. I've already explained that in the beginners class. You guys should actually go review it. That will be assignments. Write it down. Find out what stop losses is, where people set it most of the time, and then the last thing is what all these buy limits, buy stop, all these stop orders, buy stop and sell stop, basically what it means. Find it out. Okay, so just write it down. Don't forget the assignment. Once you do the assignment, just drop it on the chat. I'll check it. All right, I'll react to it even if I don't reply. Okay, I would pay attention. You see, everybody that is attending this particular meeting, eventually it will get to a stage where I would have to separate let me say, the wheat from the chaff. You know, the people that have been consistent. It will get to a stage where some of my knowledge, I won't be able to just give it out for just anybody. I won't be able to like record it and send it to you guys. Okay. So it will be like you are there, I give you the knowledge, you guys learn it, and then you go practice. Do you understand? Just for privacy sake, you see, there are a lot of my stuff that most people have taken, but right now I just want to like I'm not recording. It will get to a time basically that I'm not going to record this meeting again. But I'm currently recording this meeting and I'm going to share it with you guys. But you guys should actually just follow. All right. You guys understand principle 4. If you understand principle 1, 2, 3, 4, drop 77 on chat before I continue. If I can see 3777, I'm going to continue. I'm going to continue. Okay, all right. That is actually perfect. That is perfect. All right. Now let's move to principle 5, which I think is the last principle that I wrote. This particular material, I prepared it last year, December, before the break. Before the break, actually. Before the break. I just thought, let me just wait till January before I start giving you guys this. This was the day that I prepared the material. December 26th, just after Christmas. Oh, sorry, November 26th. So let's move to principle 5. Principle 5 is this. Is there enough money for everyone? Now that you know that the market is zero sum, what do you think is the answer to that? Somebody just drop it on chat. Anybody? Do you think there is enough money for everyone in the market? Knowing what you know now. The answer is yes, and the answer is no. If you say no, you are correct. If you say yes, you are also correct. But you have to understand this, that the market is zero sum. Some people are losing, while some people are gaining. So if you lose today and you gain tomorrow, it's still yes for you. But if you lose and lose and lose, it's a no for you, basically. So there's enough money for everyone, but like I said in the beginning, the wealth in the market is not evenly distributed. See, as you're making $50, some people made $5,000. Trust me, is something very, very real. As you're making $5,000, some $5,000 is even small in the grand scheme of things. Some people made $5 million dead us. So that's just the scale of this thing. So what I'm trying to say is wealth is not created. Some people always lose. Do you get? Some people must lose because it's a zero-sum game. So the right answer to this question is no. But if you want to look at it in a very logical perspective or whatever, you can say yes too. But basically, let's look at it from, theoretically, the answer is no. Do you get? The answer is no. In trading, wealth isn't created. In any financial market, you can make money in Bitcoin. I don't care. The money was not created. Bitcoin didn't create that money. People put money there for you. Do you get? Wealth is not created. It is redistributed from the people that know more than you. Sorry, from the people that knows to the people that don't know more, better. Do you get? Or from people that know better to the people that know. Some people know all this butterfly pattern and everything. Why some people understand other flow, how other pairing happens in the market, and they just try to follow it. Do you get? So if you make 1,000 on a trade, the market didn't create that money. That's the first thing I want you to understand. Like I said at the beginning, it's a zero-sum game. It came from another trader who lost what? Who lost 1,000 fucking dollars. Okay, so money is enough for everyone, yes, but trust me, if you have $1 trillion and you lost 1 billion, it will pain you. Do you get? Because you lost the money and then other people gained it. Do you get what I'm trying to say? So wealth is not created; it is redistributed from some people to some people. Do you get what I'm trying to say? The fact that Bitcoin is at 100K or 98,000, do you get? Means some people are pumping money into it, believing that price is probably going to go to the moon. I don't know where they are expecting price to go. 120,000 or 1 million in the future. Yes, that's the reason why they are holding and then they are buying more. But one thing I want you to understand is this. I'll go to the weekly chart. You have to understand these basic tenets. The price will always look for buyers. Look at this. Okay, let me go to the recent one. That was in this was in 2021. Price reached the all-time high of 71, about 60, can you say 69,000? Let's say 70,000. People were thinking what? That will go to 100 fucking K. But what happened? Price went down, looking for more buyers. Do you get? Which means people were selling at this top to suckers that were looking for price to go to 100,000. Then a lot of people lost money, and then price started consolidating again and started going up. The process of this is to look for more buyers, but trust me, the big banks are not going to buy like they buy cheap. That is, they buy at a low and then they sell at an high. What do I mean by selling at an high? For them to sell, they have to look for people. See, all those profits taking that is happening here. Let's say they buy Bitcoin here. Do you get, for an example? Like here, when they wanted to buy Bitcoin here, they have to drive price down so that a lot of people will just fear out and sell their coin. You get, a lot of people will fear and be like, hey, this is a fucking dip. Can you see Bitcoin has dipped from 10K to 3,000? I think this was in 2020. Yes, I remember this move. Price went down and then went to 3,000. Probably it's going to zero. You know, when price is dipping, most people always think the worst. I will explain when we get to human psychology, you will literally understand the reason why trading is hard. It's not because of strategy, it's because of the psychology, human psychology behind it. When this thing happened, a lot of people thought Bitcoin was literally going to go to 400 naira, or sorry, $400. Okay. So most of people were selling their coin, thinking they will like buy from, like they will buy cheaper. But you know, it dropped, yes. A lot of people sold their coin, but as they are selling it, the big banks are accumulating. That is, as they are selling, they are buying. As people are selling, scared, they are buying cheap from them, buying cheap from them. Then they pump price up. Then now price is here at 68K. You see everybody on Twitter shouting BTC to 100K in 2021. Then you want to be like, since I didn't catch it, let me just buy and then gain the money. When it gets 100K, I'm going to sell. Did it go to 100K? No. As you are trying to buy, they are now selling to you again at an expensive price. So as they are selling, you would see that they are selling more things because there are not enough buyers. Do you get? So the price is going down to look for more, what's it called? More buyers. Do you get? So they are selling at every point. After they've made their profit, they decided to buy again from here. And then price started going up. One thing, you won't be surprised that price will still eventually come down. Do you get? Price will come down and then again reaccumulate. You see those times that price comes down, the news is going to support it. All these things, probably China bans Bitcoin, all these things happen, World War happens, everything. It's something is going to support it that will convince a lot of people to sell. They will even think Bitcoin is going to zero, but it's not going to zero. A lot of people are just, you know, these big banks, smarter than you, that have more information than you, are just trying to accumulate at a cheaper price. They never buy something that is expensive. Never. What they do is sell at an higher price. That is, they are taking profits. Do you get what I'm trying to say? They are taking profits. So we will explain that later in the future, but just understand the basic tenet of the market. So there is no enough money for everyone. Wealth is only distributed, it's not created. Do you understand? So now, let me build up a bigger picture and then we'll continue from here tomorrow. Everything that I've sent is money happens in like 5 stages. Number 1, accumulation. Retail trader places order, take profits, level at predictable levels. Emphasis on the word predictable levels. It means all those books that you've read about Fibonacci, about smart money, about inducement, about everything, you shall know everything drops down to the fact that you're going to place your orders at predictable levels and your stop loss at probably below the low. That's where most people put it. That's where I put it. Do you get above and high, below the low? So you can literally tell me that above every high, there are stop losses sitting above it, and below every low, do you get, there are stop losses also sitting below it. Stop losses, what I mean by stop losses and stops are liquidity. Do you get? So let's assume I'm a big bank and I'm looking to sell. All I have to do is find a way to take price above this high. Then I'm going to find willing buyers. Then I'm going to sell to, and then the remaining of my sell that creates a lot of supply will be looking for more what? Will be looking for more buyers. And then here, you know, for me to actually close this sell trade, I have to buy it back. But for me to buy it back, there must be people selling to me, which would be below a low. That is, people stop losses that is here, people trying to. So a lot of sell stops, and then a lot of buy, you know, people trying to buy their stop losses, sell too. So immediately price gets below this, I trigger their stop loss, even not like it's not as if they are preparing for it. It's just something extremely automatically. Once I get below this, I'm going to find enough sellers that I'm going to liquidate, that is going to like, that I'm going to take profits from. Do you get? Is both ways. You sell, but before you can take your profit, you have to buy. Like some people have to buy from you again from a very lower price. Do you get? So some people are going to, sorry, you have to buy from some people at a very lower price. So some people are going to, some people's stop loss are going to be here, and then you are going to liquidate them. Then it's always that cycle. Same thing I was trying to explain every time here. But then before, let me go here first. Let me go here. Do you get? Then let me use recent chart. Recent chart. Same thing that has been happening, we always keep happening. First, we always be looking for stop losses and everything. See, even though it was with weeks, do you get? We still took it out here. Even though, let's even forget, I will explain the psychology behind this thing, but this is another thing. The buy that happened. But then I will explain the psychology behind all this break area and everything. But just leave that for now. And then same thing that happened here. You can always track their movements. But as you train your eyes over the years, you are going to get better at reading price. But this is your foundation. Okay. So everything starts with accumulation. Retail trader trading, putting price at predictable level, our private price is going to sell from here. So they put their stop loss above this high, yeah, which is good. They allow that. Everybody is playing their game. Then slippage happens. Big player needs liquidity to execute their trade. They can't just trade $100, 100 million without affecting the price. Do you get? But I will explain what slippage means shortly. But then, let me first explain this first. Let's bring out those two lines again. There is sell, and then there is buy. Let me make it blue. Now, let's assume there are only two people in the market. If there are only sellers in the market, like too much sellers than buyers here, price will keep going down until it gets to zero. That's because people are just selling that thing, probably because it is worthless. Same thing, let me go to FTX coin. When the Sam Bankman Fried fucked all of us up, he fucked me up, I lost a lot of money. But let's go to FTX coin. That will be crypto. FTX. Or is it FTX or FTT? They've even removed it, probably. FTX. Okay, FTX token, crypto. This is it. All right. I'll go to weekly. So you guys can actually understand this. When, the bubbles of this guy busted, I'll go to Luna too, though. They're already waking up because, the new CEO is doing some kind of shitty job. But basically, when the bubble busted, a lot of people wanted to sell their coin because there were a lot of sellers. Nobody wants to buy this coin. What happened? Supply overwhelms demand, and price went to literally zero. From where? From $35, from about, what is it called, $23 per share per FTT token. It went to zero because nobody was willing to buy it. The reason why this buy was happening is because they were buying it back themselves, and then also they were, they are now waking up. But let me go to Luna, another coin that you will see that market is a reflection of everything that is happening in the real world. It's still a market. See what happened here. What do you think happened here? What happened is because sellers overwhelmed buyers. Do you get? A lot of people want to sell their coin. They don't want to lose. So, do you know the big player with the enough information already sold a lot of things? So you that is trying to sell at a lower price, this is what they call slippage. You cannot sell from here. Just when you're about to press yourself, price is going to fill you in at zero. Do you get what I'm trying to say? That was what happened here. Sellers overwhelmed buyers because a lot of people were trying to sell. They don't want to hold the coin. Nobody was buying. Do you get what I'm trying to say? So that is what they call slippage. But they try to, in forex markets, because forex market is regulated, but all this crypto market is not regulated. That's the reason why you can see this kind of movement. That's the kind of shit you see in crypto markets. But let's go to forex markets. Give me USD for an example. Like it happens, but it's not on this crypto scale. Do you get? It happens gradually. Like this kind of move is not too much, but they cannot hide their movement. That's all the things that I'm trying to say is what they call slippage. But the a slippage, let's assume they want to sell like, okay, let me reduce the price so it will be more relatable. let's assume you are the only person in the market. Like you are the market maker, you are the big baller of the market, and then you have 1,000 naira that you want to 1,000 GBP that you want to sell. Now, I will tell you the reason why you will ace slippage right now. Let's assume you don't know if there are enough. You want to sell here. Okay, let me go. Let me use the recent charts. Do you get? You want to sell here at first, but then no, there are no enough buyers. So immediately you just press 1,000 sell, it didn't activate. What happened was that only $20. You wanted to sell 1,000, only $20 activated. So the rest of the what's it called? The rest of the what's it called? The rest of the $980 or naira that you have is going down to look for buyer. So another, let's say you find another buyer here. Do you get another $20 activates till it is still going down? So you are selling from different prices because of slippage. So what you will do in that case is just try to manipulate price into a place where you can find a lot of sellers. That's the reason why they move price here. So let's say you find a lot of sellers here. So right here, let's say they were able to sell like 900. You were able to sell like 900. So it remains 100. It's still supply overwhelmed demand. So those 100 is what is looking forward. Looking for orders to fill. That is buying orders to fill. So it found it here, but the order here, the buying order here was more than the 100 that remained here. So probably people that are trying to buy here is just 500. They are trying to buy 500. You've already filled in 900 here. It remained 100 that you wanted to fill. So you sold 100 here, but 500 was here. It remained that 400 that remained. You start looking for what selling order. So you sold again here. A lot of things that I'm going to explain in the future, but just understand that it's a war, tug of war between buyers and supply. But the big banks always tend to avoid slippage. They want to, they want to make sure they fill in all their price at the highest price. They don't just want it to fall. So they can keep price up here until they fill in all their order before it falls, before they allow it to fall. So they will be manipulating people, creating patterns that they want to see so that they can start buying, and then they will be, they will be paying their order with them. Then once they are done paying their order, they remove the support, and then markets can fall to wherever I want to fall to. Do you get? Now, the third thing is liquidity graph that I explained. Big player push the market towards the orders, liquidity pools, where all your stop losses and whatever is predictable. Even take profits is an order too. Do you get? It's not only stop losses that they look for. They look for people's take profits too. They just want people to do something. Do you get? Basically. And then order pairing, they pair their order with your whatever, your stops and your whatever. And then the last thing that happens is expansion. That's when they allow market to just fall and go wherever it wants to go. So that will be the end of the meeting for today. Okay. That will be the end of the meeting for today. If you have any question, I'm going to be allowing you to put on your microphone. And then if you cannot talk, say your background is noisy, you can just drop your message on the chat, and then I'm going to be answering your questions. So who is the first person? Who is going first? Who is going first? Who has any question? I wasn't really following, so I watched the recording. All right. Who has any question? John, Julius, Michael, Olademeji, Emilade. Okay. I'm going to assume everybody understand. If you understand everything that I've said since morning, drop 777 in the chat.